The most dangerous change in money does not begin when a government bans something. It begins when ordinary people stop noticing that permission has replaced ownership. That is the quiet line I want you to remember. A poor man thinks the question is, how much money do I have? A middle-class man thinks the question is, how fast can I earn more? A rich man eventually learns who controls the pipes my money must travel through. That question sounds boring until the pipe closes. For most of my life, money had a stubborn quality. A dollar did not care what you believed, where you worked, what you said, or which database liked you. If you had a dollar, you could hand it to another person, and the transaction was finished. Cash was not perfect. Criminals used it, fools wasted it, governments inflated it, banks abused it. I have never been sentimental about paper with portraits on it. But cash had one virtue modern people are beginning to lose. It was neutral. It did not ask for your identity before it worked. It did not need a server to bless the transaction. It did not expire because someone wanted faster spending. It did not fail because your face could not be recognized. Your account had been flagged or your behavior had to be reviewed. That neutrality is now being redesigned. And the people treating this as a technology story are missing the financial story. The financial story is not whether digital ID is convenient. Of course it is convenient. It is not whether stablecoins can make payments faster. Of course they can. It is not whether AI can detect fraud, bots, deepfakes, and stolen identities better than a tired clerk at a bank branch. Of course it can. The financial story is that the same machine that reduces friction can also create permission. And in finance, permission is never free. I have seen this pattern in business again and again. First, a tool is sold as convenience, then it becomes standard, then it becomes expected, then it becomes required. And once it is required, the man who owns the tool owns the gate. That is the great migration taking place now. Money is moving from a possession to an access credential. Identity is moving from a card in your pocket to a biometric key. Markets are moving from ownership records to programmable ledgers. Public life is moving from privacy by default to verification by default. I am not telling you to panic. Panic is expensive. I am telling you to diagnose. When a doctor finds a tumor early, he does not scream at the patient. He marks the boundary, studies the growth, and decides what must be cut out before it spreads. That is how I want you to look at the new financial system. Not as prophecy, not as a movie, not as a campfire story about the end of the world, as a balance sheet, because the balance sheet is already changing. I call the first mechanism the permission premium. A permission premium appears whenever a system charges you, directly or indirectly, for the right to use what you thought you already owned. You may think your bank balance is yours, but you already know that is only partly true. Your bank can ask questions. Your bank can delay transfers. Your bank can file reports. Your bank can freeze activity if compliance alarms start ringing. The new question is what happens when the bank is no longer the final gatekeeper? What happens when the gatekeeper is a stack of identity providers, payment networks, stablecoin issuers, app stores, device makers, exchanges, tax authorities, and AI risk engines all talking to one another? One gatekeeper can be negotiated with. 100 invisible gatekeepers become weather. You do not argue with weather, you just get wet. That is why I pay attention when money becomes more programmable, identity becomes more biometric, and surveillance becomes more automated at the same time. Each piece by itself has a decent argument. Stablecoins can make payments faster. Digital identity can help prove that a human is not a bot. Biometrics can reduce fraud. AI analytics can help institutions make sense of huge amounts of data. Tokenized markets can make settlement faster. None of those sentences sounds frightening. The danger lives in the combination. A lock is not dangerous because metal exists. A lock is dangerous when someone else holds the key to your door. That is the second mechanism. I call it the keychain problem. Every modern financial life has keys. There is a key to your bank account, a key to your brokerage, a key to your phone, a key to your taxes, a key to your medical portal, a key to your travel documents, and a key to your business. For a long time, those keys were messy and separated, inefficient. Yes, annoying, yes. But separation gave ordinary people a kind of accidental protection. One system might know what you bought, Another might know where you traveled. Another might know who you paid. Another might know your age, health, credit score, and address. They did not all know it at once. Now the commercial incentive is to unify them. The government incentive is to monitor them. The banking incentive is to de-risk them. The technology incentive is to automate them. And the investor incentive is to own the companies that provide the rails. That is why the same words keep appearing everywhere. Identity, verification, compliance, fraud prevention, safety, efficiency, trust. Those words are not lies. They are half-truths. Half-truths are more powerful than lies because they walk through the front door wearing respectable clothes. Artificial intelligence is making it harder to know whether an online user is a person, a machine, a scammer, or a synthetic face with a stolen voice. Payments are global. Fraud is global. Sanctions are complicated. Digital assets move faster than regulators. Governments have debt to finance. Banks have compliance costs. Consumers want speed. So the system says we need verified humans. Then it says we need compliant money. Then it says we need unified data. Then it says we need real-time monitoring. At the end, it may say we need permission before the transaction can clear. That is not a leap. That is a staircase. And wealth is lost by people who do not notice staircases until they are already on the top floor with the door locked behind them. Look at the identity layer. When a person scans an iris to prove humanness, the stated goal is not wicked. The stated goal is to prove that one person is one person in a world where bots can flood every platform. That is a serious problem. If every app becomes filled with artificial accounts, commerce decays, trust decays, dating apps become farce. Ticketing becomes a war with machines. A proof of human system answers a real need. But the investor must always ask the second question. What else can this proof unlock? If an identity proof becomes common enough, it can move from optional to expected. If it becomes expected, businesses start building around it. If businesses build around it, non-users are treated as risk. If non-users are treated as risk, they are priced differently, delayed, excluded, or forced through inferior channels. That is how defaults become mandates without anyone voting for a mandate. At first, an email address was optional. Then it became normal. Then it became required to access your bank, airline, doctor, employer, tax forms, and brokerage. At first, a smartphone was a convenience. Then it became a ticket, a wallet, a map, a work device, a camera, a key, and an authenticator. Again, none of this is evil by itself, but every layer that becomes mandatory changes the nature of financial independence. Financial independence used to mean that your assets produced enough cash to cover your life. In the next system, financial independence may also mean that your assets can be reached, moved, pledged, spent, and protected even when the digital weather changes. That is a different kind of independence. That is the third mechanism. I call it liquidity under supervision. Most people think liquidity means the ability to sell an asset quickly. That is the old definition. The new definition is the ability to sell, transfer, borrow, spend, or relocate capital without being trapped by a single platform, single credential, single banking corridor, single government policy, or single algorithmic judgment. A man with $1 million trapped behind a frozen account is not liquid. A woman with assets that can only move through one regulated gate is less free than she thinks. A business that depends on one payment processor, one app store, one cloud provider, one social platform, and one banking relationship may look modern, but it is not robust. It is elegant glass. And glass breaks loudly. The intelligent investor does not respond by hiding money under a mattress. That is childish. The intelligent investor responds by building redundancy. He keeps more than one banking relationship. He understands how his brokerage clears trades. He keeps emergency liquidity in forms that do not depend on one password or one institution. He keeps records that can survive a locked account. He does not put every asset, every cash flow, every line of credit, every document, every identity proof, and every investment inside one beautiful digital cage. The cage may be convenient. It is still a cage. Now look at the money layer. Stablecoins are often described as digital dollars. That phrase is too simple. A stablecoin can be useful. It can move value across borders, support tokenized markets, and makes settlement faster. But it also changes who sits between you and the dollar. When a stablecoin issuer holds reserves, follows banking rules, complies with sanctions, and connects into the government reporting structure, that issuer becomes a regulated doorway into digital dollars. That may be necessary. A financial system without law becomes a sewer. But a financial system with too many programmable gates becomes a leash. The difference between a payment rail and a control rail is not always the technology. It is governance. Who can freeze it? Who can blacklist it? Who can see the pattern? Who can change the rules after the public has already adopted the system? Those questions matter more than the marketing brochure. The naive person asks whether the app is easy to use. The serious investor asks who controls the reserve, who writes the compliance rules, who owns the data exhaust, and who earns interest on the float. Follow the float. In every financial revolution, somebody makes money from float. Banks collect deposits before they lend. Payment companies collect fees while money moves. Asset managers collect fees on balances. Stablecoin issuers can hold reserves in short-term government paper and earn yield, while users treat the token like cash. The person staring at the app sees convenience, the owner of the rail sees float, and the government sees a new buyer for its debt. You do not need a conspiracy to explain this. Incentives are sufficient. Governments running large deficits need buyers for bonds. Stablecoin systems backed by treasury bills can create demand for those bills. Large asset managers want tokenization because every stock, bond, fund, and contract placed on a ledger becomes easier to trade, package, lend against, and charge fees on. Data companies want more data. AI companies want more compute. Power companies want more demand. Politicians want modernization that helps finance promises they cannot pay for honestly. That is not theology. That is a capital flow map. The fourth mechanism is the in the old world, collateral was a house, a farm, a factory, a portfolio, or a receivable. In the new world, behavior itself becomes part of the collateral file. Do you pay on time? Do you verify your identity? Do you comply with platform rules? Do you travel where the system expects? Do you transact in approved channels? Do you generate risk flags? The more financial life moves onto unified ledgers, the more every action becomes a potential input into pricing. Your loan rate, insurance premium, account status, transaction limit, platform access, and investment eligibility can all be adjusted by models that see more than any banker ever saw. Some people will benefit from that. A responsible borrower may get cheaper credit. Fraud may become harder. Small businesses may get faster underwriting. International payments may become cheaper. There is always an upside. That is why the system grows. But the downside is that a mistaken model, a political dispute, a compliance error, or a single credential failure can affect more of your life than ever before. When systems are separate, errors are local. When systems are unified, errors metastasize. That is why I do not worship efficiency. Efficiency is wonderful inside a factory. Efficiency is dangerous inside a society when there is no room for human appeal. A perfectly efficient machine can do the wrong thing faster than a sloppy human can. Now look at the hardware layer. The world is building a physical nervous system, cameras, sensors, satellites, cloud platforms, AI data centers, payment terminals, biometric devices, connected cars, smart meters, and digital wallets. Each piece can be defended. Cameras reduce theft. Satellites connect remote areas. Data centers power useful AI. Digital wallets reduce friction. But a nervous system does not merely help the body move. It also tells the brain what the body is doing. The companies that win in this era will not merely sell apps. They will own the nerves, identity, payments, data, compute, power, security, and analytics. A data integration company becomes an interpreter of institutional reality. A proof of human company becomes a possible gatekeeper. A stablecoin issuer becomes a reserve manager, compliance interface, and payment network. The new grid needs identity, money, data, compute, electricity, and enforcement. Those who own the pieces may collect tolls for decades. Those who depend on the pieces without understanding them may pay tolls for decades. That is the fifth mechanism. I call it toll booth capitalism. The best businesses in the world often look like toll booths, a railroad in the right corridor, a payment network between merchants and buyers, an app store between developers and customers, a cloud platform between companies and computation. Toll booths are beautiful businesses when you own them, and suffocating systems when every road has one and you own none of them. That is the identity flip I want you to make. Stop thinking only as a user. Think as an owner. The user asks, "Is this convenient?" The owner asks, "Who earns the fee when everyone adopts it?" The user asks, "Can I pay faster?" The owner asks, "Who holds the reserve while payment clears?" The user asks, "Can I verify myself online?" The owner asks, "Who becomes the trusted credential provider?" The user asks, "Can AI make life easier?" The owner asks, "Who supplies the power, chips, data centers, security, and enterprise software?" That is the difference between being managed by the system and owning pieces of the system. I do not want you to become paranoid. Paranoia is just ignorance, dressed in dramatic clothing. I want you to become structurally aware. A structurally aware person can hold two truths at the same time. Digital identity may solve real problems, and mandatory identity can become a financial choke point. Stablecoins may create faster payments, and regulated rails can become instruments of surveillance. AI analytics can help institutions operate better, and unified data systems can create new risks for privacy and civil liberty. Adults can hold two truths at once. Markets do not require villains. Markets require incentives. The sixth mechanism is the crisis ratchet. Institutions rarely gain permanent powers during calm periods. They gain them during crisis. A war, a banking panic, a pandemic, a cyber attack, a market crash, an energy shock, a wave of fraud, a deepfake crisis, a sovereign debt scare. During a crisis, the public wants speed more than process. They want safety more than debate. They accept new tools because the old system appears broken. Then the crisis fades. The tool remains. That is the ratchet. It turns one way. I have no interest in predicting which crisis will justify which layer of the new system. Prediction is a game that makes fools feel brave. Preparation is better. And preparation begins with a protocol. I call it the ownership and optionality protocol. Do not make your life dependent on one gate. Do not keep all liquidity in one institution. Do not build a business that can be killed by one platform policy. Do not confuse digital convenience with legal control. Do not confuse a rising account balance with durable freedom. Own productive assets, cash flow, businesses that sell necessary goods and services and pieces of toll booths if the price is sensible. Own some liquidity that can function when systems are slow, suspicious, or temporarily hostile. Own knowledge of how your money actually moves. Own enough humility to know the future will not match the story in your head. That is how a rational person prepares. You cannot stop the world from digitizing. You cannot vote away technological incentives. You cannot shame governments out of wanting more visibility. You cannot persuade banks to ignore compliance risk. You cannot prevent AI from making identity more valuable. You can decide whether you will be merely a verified consumer inside the machine or a disciplined owner of assets that survive the machine. That is the real choice. I would rather own the railroad than argue with the conductor. I would rather own the payment network than complain about fees. I would rather own businesses with pricing power than curse inflation at the grocery store. I would rather own durable assets in multiple structures than discover, at the worst possible moment, that all my freedom depended on one login. Now, let me be blunt about what this does not mean. It does not mean you should rush into every company with AI in its presentation. It does not mean you should buy every surveillance company because governments are customers. It does not mean you should buy every stable coin, crypto token, biometric company, defense contractor, or data center stock. A bad business in a good theme is still a bad business. A rotten horse does not become secretariat because it stands near a racetrack. The discipline remains the same. Look for businesses with real revenue, durable advantages, honest accounting, capable management, sensible leverage, and a price that does not assume heaven. The fact that a market is important does not mean every stock inside it is a good investment. Railroads transformed America. Many railroad investors were ruined. The internet transformed the world. Many internet investors were ruined. AI will change business. Many AI companies will turn into footnotes. Digital identity, stablecoins, tokenization, and surveillance infrastructure may reshape finance. Many investors chasing them will still lose money. The future can be real and overpriced at the same time. That is the part inexperienced investors miss. They hear a powerful story and forget to count. Never forget to count. If a company is priced as if it will own the world, it must come very close to owning the world just to give you an ordinary return. If a company is small, necessary, profitable, ignored, and positioned inside a durable build-out, the upside can be very different. But the same old questions apply. What is the cash flow? Who are the customers? How sticky is the product? What happens if regulators change their mind? What happens if public opinion turns? What happens if the largest customer disappears? What happens if capital markets close for 2 years? What happens if the technology works? But the stock was already priced for perfection. Those are the questions that keep you from turning a serious trend into a childish bet. A man who owns assets he cannot move is not as rich as he looks. A man who has income from a platform that can erase him overnight is not as secure as he feels. A man who has one bank, one broker, one passport, one payment processor, one cloud provider, and one source of cash flow has not built wealth. He has built a dependency stack, and dependency stacks collapse from the top. So here is the blueprint I would give a family that wants to stay sane. Build boring wealth first. A cash reserve, low debt, productive assets, broad ownership of businesses, some real-world resilience, careful records, multiple financial relationships, tax awareness, a habit of reading the rules before they become emergencies. Then, if you want exposure to the new rails, buy them like an investor, not like a frightened citizen. Study identity companies, payment networks, cybersecurity, tokenization infrastructure, data analytics, power generation, data center builders, and businesses that supply the digital nervous system, but demand quality, demand balance sheet strength, demand customer stickiness, demand proof that the business can make money without endless dilution, demand a margin of safety. If you cannot understand the business, do not buy it. If you cannot understand the risk, do not pretend the upside makes the risk disappear. And if the only reason you want to buy something is that you are afraid of the future, walk away for a week. Fear is a terrible portfolio manager. The best preparation is not theatrical. It is dull. It looks like avoiding bad debt. It looks like owning assets. It looks like keeping optionality. It looks like refusing to hand every key in your life to one institution. It looks like teaching your children that money is not merely numbers on a screen. It is a claim on choices, and the real purpose of wealth is to protect those choices. Now we come to the final test, not a test of religion, not a test of whether you can predict the next crisis, a test of ownership. If tomorrow your favorite payment app stopped working, could you still function? If your bank delayed a transfer, would your life freeze? If your brokerage required extra verification during a volatile market, would you have other liquidity? If your business lost one processor, one platform, or one digital gate, would cash flow survive? If inflation kept eating the currency while asset owners got richer, would you be on the owner side or only the wage side? If every financial interaction became more trackable, programmable, and conditional, would your wealth still give you freedom? Or would it merely give you a higher spending limit inside someone else's system? That is the mirror. Most people will look into it and see a consumer. I want you to look into it and see an owner. An owner does not need to shout. An owner does not need to panic. An owner does not need to believe every dark theory or every cheerful press release. An owner studies the pipes, buys what is durable, avoids what is fraudulent, and keeps enough independence to say no. Because the oldest truth in finance has not changed. The man who needs permission at the wrong moment pays whatever price the gatekeeper asks. The man with options waits, and waiting, when you have real options, is one of the most profitable powers in the world. So do not ask whether the digital grid will arrive exactly as its critics fear or exactly as its promoters promise. Ask the question that matters more. If the world keeps moving in that direction, are you building a life that becomes more dependent, or one that becomes more optional? That is the contract with your future self. You will either become easier to manage or harder to trap. You will either rent access or own resilience. You will either chase convenience until it becomes permission, or you will build enough ownership that convenience remains a tool, not a master. The next age of money will not announce itself with a bell. It will arrive one account update, one identity check, one payment rule, one compliance notice, one app integration, one tokenized asset, one crisis response at a time. By the time everyone agrees that the system has changed, the best positions will already have been taken. That is usually how wealth works. The door opens quietly, most people walk past it. A few people notice the hinges. I have always preferred to notice the hinges.